Investing can be one of the most powerful ways to grow your money over time. But when people first start investing, many of them make the same mistakes. And the frustrating part is that most of these mistakes are completely avoidable. Some mistakes cost a little. Others can cost people hundreds, thousands, or years of progress. That's why in this video, we're going through 7 investing mistakes beginners make, and more importantly, how to avoid them. If you're new to investing, understanding these early can save you a lot of stress later on. Because investing is not really about being cleverer than everyone else. A lot of the time, it's simply about avoiding the obvious mistakes, staying patient, and letting time do the hard work. So, let's get into it. The first mistake beginners make is trying to get rich quickly. You've probably seen this all over the internet. Someone claiming they doubled their money in a week. An ad promising massive returns. A post saying this one investment is about to explode. And it all makes investing look fast, easy, and exciting. But real investing usually doesn't work like that. The most successful investors tend to build wealth slowly, steadily, and over a long period of time. That may not sound as exciting, but it's usually much closer to the truth. The problem with trying to get rich quickly is that it pushes people toward bad decisions. They start chasing risky investments. They jump into things they don't understand. They buy into hype. And sometimes they fall straight into scams. That's because the promise of quick money is one of the easiest ways to attract beginners. If somebody tells you that you can double your money quickly, or that there's no risk, or that this is a once-in-a-lifetime opportunity, that should immediately make you more cautious. The goal of investing isn't to become rich by next month. It's to put your money to work so it can grow over the long term. And that's a very different mindset. The second mistake beginners make is investing in things they don't understand. This happens all the time. Someone hears about a stock, a fund, a crypto project, or some complicated investment product, and they buy it simply because other people are talking about it. Maybe a friend mentioned it. Maybe they saw it on social media. Maybe it just sounded smart and impressive. But if you don't understand what you're investing in, it becomes very hard to judge whether it's actually a good idea. A simple rule many investors follow is this: never invest in something you don't understand. That doesn't mean you need to become an expert in everything, but you should understand the basics. What does the company do? How does it make money? Why do people think it might grow in the future? If you can't explain those basics simply, you probably shouldn't be putting your money into it yet. A lot of beginners worry that they'll miss out if they don't act quickly. But missing out on something you don't understand is often much safer than rushing into it blindly. Because when the price suddenly drops or bad news comes out, people who didn't understand the investment in the first place often panic, and that usually leads to another bad decision. Understanding what you're buying gives you confidence. It helps you make calmer decisions, and it lowers the chance that you'll invest based purely on emotion or pressure. The third mistake beginners often make is following hype. A stock starts trending. A creator talks about it. People post screenshots of gains. Comment sections fill up with people saying it's going to the moon. And suddenly, it feels like everyone is making money except you. That feeling can be powerful. No one wants to feel left behind. But hype can be very dangerous when it comes to investing. By the time most people hear about an investment, the price may already be very high. That means beginners often buy after a big rise has already happened. And then, not long afterwards, the price can fall. Good investors don't chase hype. They follow a plan instead. This doesn't mean every popular investment is bad. Sometimes things become popular for good reasons. But buying simply because other people seem excited is risky. You're no longer investing based on research or strategy. You're reacting emotionally to what's happening around you. And emotional investing is often where mistakes begin. One of the hardest things for beginners is accepting that you do not need to catch every opportunity. You do not need to own every trending stock. You do not need to jump into every popular investment. Sometimes the smartest thing you can do is nothing. Sometimes the best move is to stay patient and stick to your own plan. Hype makes investing feel urgent, but good investing is rarely urgent. The fourth mistake is panic selling. This is one of the most common investing mistakes, especially when people are new. A lot of beginners start investing expecting the market to go up steadily all the time. And when it doesn't, they're shocked. But markets do not move in straight lines. Prices go up, and prices also go down. Sometimes those drops are small, sometimes they're uncomfortable, and sometimes they happen very quickly. When beginners see their investments fall in value, it can feel personal. It can feel like something has gone badly wrong. They open the app, see red numbers, and immediately want to get out. That reaction is understandable, but it can also be very costly. Panic selling can lock in losses. If you sell while prices are down, those losses become real. And if the market later recovers, you may have sold at exactly the wrong time. Experienced investors understand that short-term drops are normal. They focus on the long term instead of reacting to every movement. This is one reason why mindset matters so much in investing. If you expect markets to wobble sometimes, those drops feel less shocking. Long-term investing means accepting that short-term volatility is part of the process. The fifth mistake beginners make is not diversifying. In simple terms, that means putting too much money into one thing. Maybe it's one company, maybe it's one industry, maybe it's one type of asset. Whatever it is, the risk is the same. If that one investment performs badly, your whole portfolio takes a big hit. A simple phrase people often use here is, don't put all your eggs in one basket. If all your money is tied up in one investment, and that investment performs badly, you could lose a lot. Diversification spreads your risk across multiple investments. That way, one bad result has less power to damage everything. This is one reason beginners often choose index funds, because they can give exposure to many companies at once. Diversification doesn't guarantee profit, and it doesn't remove risk completely. But it can reduce the damage caused by one poor investment choice. The sixth mistake is investing money you might need soon. Some people start investing with money that should really be kept available for short-term needs. That could be rent money, bill money, emergency savings, or money they'll need in the next few months. The problem is that investments can move up and down in the short term. That's why many investors only invest money they won't need for several years. That longer time frame gives investments time to recover from short-term drops and volatility. The final mistake beginners make is ignoring fees. There's no excitement here, just small charges in the background. And yet, over time, those small charges can quietly make a big difference. Fees might seem small at first, but over the long term, they can reduce your overall returns. That's why it's important to understand the costs involved before you invest. A small percentage may not sound like much today, but over many years, it can quietly eat into your gains. Investing doesn't have to be complicated, but avoiding these common mistakes can make a huge difference over time. Take your time, learn the basics, understand what you're investing in, ignore hype, think long term, and try to avoid emotional decisions. Because for most beginners, successful investing is less about doing something clever and more about consistently avoiding the obvious traps. If you're new to investing, check out the other videos on the channel where we explain the basics step by step. And if you found this helpful, consider subscribing for more simple explanations about money and investing.